I was asked today to cover a couple of things, and you'll notice on my first slide, I talked about it being savings programs, not retirement plans. So what I'm going to cover off today is group RRSPs or RRSPs in general. I'll cover off deferred profit sharing plans, which in our world we call DPSPs. And then I'll cover off tax-free savings accounts. Then I'll move on to just kind of go through some of the evolution of these programs as well as some of the trends that are happening in the marketplace today. So for example, we're seeing a big shift from pension plans to what I consider savings plans. So what I'm covering today, I view as savings programs, not so much retirement plans. And I'll talk to you a little bit about why I consider that as we go through. And then we'll talk a little bit about the plan governance guidelines that supports the rules and regulations or some guidelines on keeping good governance for your plan and basically keeping you out of litigation. And they pretty much came up with CAP guidelines, which I won't go through each guideline, but just kind of share with you what's out there. So what is a group RRSP in general? So a group RRSP, very similar to an individual RRSP with a couple of added advantages. So the actual definition is it's a tax-assisted savings plan designed to offer a convenient and tax-effective way for employees to save for retirement. So where the group aspect comes in is really offering them that payroll deduction and the real convenience of being able to save through payroll deduction. A plan that's established, it's established through your employer, and it must be registered with Canada Revenue Agency or CRA. Vendors, typically, the Manulifes of the world, the Great Wests of the world, the Sun Lifes of the world, are the ones that take ownership in registering the product. Most group RRSPs, most vendors, have what we call a specimen product. So we've submitted our base product to the government, it's a specimen. They come back and say, yes, Manulife, you can sell this product as a specimen to any of our clients. So it really helps reduce the registration work at the end of the day for each individual client. So that's already registered in most cases. Then within the group product, each individual member must also register by completing an enrollment form that actually puts them under that specimen registration. So now everything is registered with the government. So I thought I'd cover off some of the rules and regulations that apply to all vendors as well as to any employer that wants to offer this type of program, as well as move on to a little bit of plan design options and some examples. So bear with me as I go through some of this boring stuff that I know a lot of you, it's repetitive and you know about it, but I thought I'd cover everything. So first of all contributions that any individual Canadian puts into an RRSP are fully tax deductible. So every dollar we put into an RRSP, we can immediately deduct off our taxes. In addition to that, we have the option to put money into a spousal RRSP. We don't get any extra RRSP limit for that, but we do have the option to put it in our name or into our spouse's name. I won't get into too much detail as to why that exists, other than when you reach retirement, much more tax effective to have two people earning smaller incomes than one person earning that larger income, so less tax at the end of the day. A lot of new rules in place for pension splitting at retirement that helps us get away from group spousal RRSPs, but it is still an option out there. Employers are authorized to offer immediate income reduction via payroll deduction. So in the past, we used to have to apply to the government, ask for the authorization, do pre-authorized payroll deduction, saving them tax. Now it's a blanket authorization. So as soon as you have a group RRSP in place, you're authorized as an employer to give them that immediate tax savings. Investment income earned within an RRSP is tax sheltered during the accumulation stage. So until that money is actually coming out of an RRSP, both your contributions are tax deductible and all of your investment earnings are also hopefully growing tax-free within that program. 2 tax receipts are issued annually. That again is a regulation, so all RRSP issuers have to live up to this regulation. There's 2 that are issued every year. One for the first 60 days of the year, one for the balance of the year. And the reason for that is every individual has the option, should they contribute within the first 60 days of a year, to use that deduction for the current year or go back and use it for the previous year. So for example, if I put a contribution in February 2014, and as I'm doing my taxes, I realize I don't need that for 2013, I can actually hold on to that receipt and use it for 2014 as well. So each individual has to be given that option. T4 is upon withdrawal. So anytime there is a withdrawal from an RRSP program, the issuer must issue a T4. So again, Manulife or any vendor would actually offer that service for you. Tax-free transfers are permitted. So again, this is the law. You can put some restrictions around this, but the law does permit anybody that has an RRSP account to actually move that RRSP tax-free from one account to another or one vendor to another at their own option. So those are some of the basics for the rules and regulations, and those are what I would consider the main provisions that actually govern group RRSP programs or any individual RRSP. So let's talk a little bit about how does the administration work from a plan sponsor point of view or an employer point of view. Greatest thing about group RRSPs, and one of the things that makes them most popular, is that there is actually no CRA ongoing reporting requirements to the government on group RRSP programs. So once it's in place, you're pretty much free from any government reporting or any fees from the government, which is a nice feature. It provides eligible employees with enrollment information. So every employer that offers a program, their responsibility from an admin point of view is to actually provide that information to the members. That information is really, really important. Most vendors are the ones that actually prepare and gather that information and provide you with it to give out to your employees. You must forward the completed enrollment form. So as the employer, you're responsible for giving out the information, but you're also responsible for ensuring that that information gets to the vendor and their account gets set up. The next phase is you then set up the payroll. So they're interested, they've completed the forms. Now they need to tell you at the end of the day how much they would like to contribute, whether that be a flat dollar amount or a percentage of their earnings. They will provide you, or you will provide them with a payroll form to get your payroll system set up for them. The next, task that you have is once it's all set up, every pay period or whatever frequency you choose, your role is to do the payroll deductions and actually get that money into your vendor. So that is part of your responsibility. And then update member information, or maintaining updated information on members, is an ongoing task for an employer. And then once a member terminates, that's pretty much where your tasks end. Once you notify your vendor, in most cases, the vendor takes over from there. We understand that when employees leave, most times they don't want to be dealing back with an employer that they're leaving. So most vendors have processes in place that actually allows them to come directly to us and settle their accounts. So really, that's the administrative burden or tasks that are imposed on an employer when it comes to a group RRSP. One of the nicest things about having minimal plan rules and regulations is it maximizes your plan design options when it comes to actually offering a program to your employees. Now, a lot of people will say to me, well, what type of plan design should we put in place, and what do you recommend? Honestly, I have one question that I always ask employers, and I think it's a really important question. What's the purpose of you putting this plan in place? Once I have that answer, or most vendors have that answer, they'll find a solution for you. So is it really to help them save for retirement? Is it really to help them put money away for a rainy day? Is it to help them purchase a home? So really having an understanding as an employer, as a plan sponsor, what is the reason we're putting this plan in place? Once you have that answer, we're pretty good at helping you do a plan design. So under a group RRSP, lots of flexibility because there's not too many regulations out there. So from an eligibility point of view, again, tons of flexibility. You can offer it to all of your employees or to a certain group of employees. So that can be broken down, we call them classes. It could be broken down by full-time, part-time, or contract employees. It can be broken down by types of positions, so senior executives or administration staff, field staff, and your eligibility requirements can differ for each one of those classes. So I'll give you an example. Most times we'll see the plans for full-time employees. Part-time employees are eligible, but they have certain other rules that they'll put around that. They have to meet a certain number of hours a year or a certain income level before they actually offer them the program. So again, total flexibility on eligibility. From a membership point of view, in order to become a member, you really have two different provisions. You can either say the plan's compulsory and it's a condition of employment. As soon as you join the company, the plan is compulsory once you hit certain service levels. Or it can be completely voluntary, meaning that the employee, once they're eligible, then chooses whether they want to join or not. Okay, so again, you as the employer have the opportunity to decide what those provisions are. So when it comes to contributions, main thing you need to know is you are permitted to put both employer money into the program as well as employee money. The key thing to remember is if, as a plan sponsor, as an employer, you're willing to put money into an RRSP, that RRSP contribution that you put in their name is a taxable benefit. So in reality, the only thing you're offering them on that money is immediate immediate tax deduction. But other than that, it's taxable income to your employee. They're subject to all of your payroll taxes other than income tax. You have the right or the authority to deduct that contribution prior to income tax, okay? Really important to understand that, because by offering a program and choosing an RRSP, it may also be increasing your payroll taxes, not just your contributions. So keep that in mind if you're considering that. And employer contribution formula can be as creative as you really want to be. I'll be honest with you, I can go into some really creative plans that we have on the books that work for some employers. Just to give you a few examples, you know, your employer contribution can simply be based on members contributing to the plan. So you can say, for example, if this is offering a matching component. So for example, we will match 100% of what you put into the program. So you're requiring them to put money in order to get the employer component. You can make it just a flat percentage of earnings or flat dollar amount, so not require the employee to put any money into the program. And it can be based on different levels, based on different years of service. So you can say, for example, and I do have examples, but I'm kind of going through them already. Somebody that has under 5 years will contribute up to 2%. Somebody that has between 5 and 10 years, we're going to go up to 5%. So you can really design it and offer some additional contribution room for people that have longer service with the company. The other thing that we're seeing more and more is the last one, which is a percentage of member contributions to the plan. So a lot of companies don't have plans in place because of affordability, cash flow, and that is definitely a good reason. Most companies have a hard time with their cash flows meeting day-to-day and group benefits. So group pensions is usually an afterthought. But what we're seeing more often is they're saying, okay, well, we can't afford a whole lot, so what we're going to do is we're going to match a certain percentage of what the members are putting in. So they may say, we will match 1% of what the employees are putting in the program, or 10% of what they're putting in. So really what the employer's offering is a return on their investment just by joining the plan, not so much a whole lot of contributions, but at least a decent rate of return. Employee contributions should always be done through payroll deduction when it comes to group RSPs from an employer perspective, and typically pre-tax. I will tell you, I have some clients that don't offer the pre-tax aspect, which kind of defeats the purpose of a group RSP, but it really is dependent on your payroll systems. Some older payroll systems didn't allow it, so they're not offering it. So contributions from an employee perspective can be systematic, based on either every pay period, or could be based on a certain percentage of earnings or a flat dollar amount. Or as an employer, if you do have bonuses that you pay out or you have certain commissions that are paid out, you can also offer a one-time payroll deduction for people that are in those categories. Again, you have total control on whether you offer that or not. Withdrawal restrictions. So this is a really interesting one. You know, everybody knows that an RRSP belongs to the annuitant or the individual that owns the RRSP. So every dollar that an employer or plan sponsor puts in on behalf of an employee, that money belongs to the employee or the member. Now what we allow, or what the regulations allow, is you can put some restrictions on when they can actually withdraw that money. So typically we'll see restrictions on two different types of money. So you can restrict the withdrawal of the company money, and as an employer, you have the option to also restrict the withdrawal of any employee required money. So that's the money that an employee may be required to put in order to get that company match. So you can say, we're going to match, but you're not allowed to touch your money, and you're not allowed to touch the company money until a couple of things happen. You terminate employment, retire, or you die. Okay, so those restrictions are allowable. I know for most vendors it's part of their specimen product, so it gives you a little bit more opportunity to make sure that they're not going out there and buying a boat with the company money three years down the line. It really gives you an indication that it's there for retirement, hopefully, ultimately. The other option we're seeing, or the other option you have as an employer, is instead of saying you're not allowed to withdraw your money, you can say, you know what, you can withdraw your money anytime, but should you withdraw it, we're going to impose a penalty. So typically what we see is the penalty being one of two things. The penalty is typically, we're going to stop contributing for a certain period of time because you took money out. Or the other one that we're seeing is, if you take money out, no problem, but you're not allowed to get back into the plan now for another 2 years versus the first eligibility. So they're imposing re-enrollment provisions to, again, discourage people from using their RRSPs more as bank accounts versus an actual retirement program. Usual exceptions in 99.9% of the cases, with all of the cases I have, if there's an employer component, and there is restrictions on withdrawals or a penalty, they will lift those restrictions or penalties if employees are taking out their funds for two reasons. To go out and purchase a home through the Home Buyers Program, which is a CRA program allowing people to take money out, or take money out through the Lifelong Learning Program, which again is a CRA program allowing people to give themselves a tax-free loan from their RRSPs to go back to school full-time. So that's what I typically see from a withdrawal restriction provision. So let's move on to DPSPs, which I will say are becoming more and more popular in the marketplace today for a couple of reasons, and we'll go through them. So what is a DPSP? So a DPSP is a deferred profit sharing plan, which is a tax-assisted saving plan designed to reward good performance and create a sense of partnership for employees. So this is a program that, again, is registered with CRA, but it must be registered through a trust. So all of the money that is sitting in a DPSP is held in trust, okay? Most cases, it is trusteed through your vendor, and they usually have a relationship. I would say 90% of us all have a relationship with a trustee, so it's seamless and done behind the scenes for you, but you do have the option to self-trustee, in which case you would need 3 trustees that actually run the trust and actually do all the reporting and everything from the government. I will tell you, I'll focus today on more being trusteed through a vendor. That way you're not doing all that work. The trustees handle the registration of the plan and any amendments. So one of the things with a DPSP is you don't only have to register it, anytime you make a change to it, you need to register that as well. Very different than an RRSP. An employee, yet again, must register to become a member of the plan, which puts them under the registration of the specimen by completing an enrollment form and submitting it directly to the vendor. I should mention this. You know, there is a policy number for any type of plan you have, and then within that policy you also have what we call member numbers, or back in the day we called certificate numbers. So you have a policy number, and then each member is identified by a unique number that they choose as well. So let's take a look at some of the rules and regulations with regards to DPSPs. Again, only CRA registered and subject to Canada Revenue Agency. The first one is there are limitations on who can actually sponsor a DPSP. Because it's a deferred profit sharing plan, most importantly, you have to be a for-profit organization. I will tell you there are some exceptions on the nonprofit, which I won't get into detail, but very few. So some nonprofit do qualify, but in most cases you need to be for-profits. Don't necessarily have to be making profits, but your company has to be a for-profit organization. The other big thing to remember about DPSPs is only sponsor or company money can be put into a DPSP. So typically you would see an RRSP and a DPSP running alongside, because the DPSP can only house the company money, and then the RRSP, if they're going to require members to put money in, would actually house the employee money. DPSP annual contribution limits are determined by CRA, very different than an RRSP limit. So DPSPs have their own limit. And we'll talk about that limit as we go through the presentation. And they are determined every year by CRA, and they do get increased like your typical pension plan contribution limits in RRSPs by about $1,000 every year. Contributions must be reported as a pension adjustment. So this is an added feature that you don't see on RRSPs. So as an employer, should you put money into a DPSP on behalf of an employee, you must report that as a pension adjustment on their T4. Very simple. The pension adjustment represents the exact dollars that were contributed on behalf of that member, but that must be reported on a calendar year basis on their T4 at the end of the year. And to be honest, what that represents is that then offsets what that individual can put into an RRSP in the future year. Okay, so anything put into a DPSP in 2014 is reported as a pension adjustment on their T4. In 2015, their RRSP limit will be reduced by that pension adjustment amount. It's just to ensure that they don't get extra room by being part of a DPSP. Contributions are a non-taxable benefit. So that's what is really attracting for-profit organizations over and above RRSPs, is the fact that DPSP contributions are non-taxable. So it's as if the employee never even earned this money. Both the contribution and any earnings are tax deferred until it's actually withdrawn from the trust or from their account. So it's not subject to payroll taxes, not subject to income tax whatsoever. You must adhere to the rules and regulations around plan design. So I will touch base on a few more regulations that apply to this product versus an RRSP. And then any investment, growth, and contribution is tax sheltered until withdrawn, same as an RRSP. T4s are issued upon withdrawal as well. Again, your trustee will handle all that. If you self-trustee, you're responsible for doing that reporting. And then a DPSP also has to do an income tax return every year, and it has to be declared to Canada Revenue Agency. So again, 99% of the time, your trustee will handle all of that. The nice thing about your annual or your tax return on a DPSP is there's no fees to do it either. So there's no ongoing fees on a DPSP. So ease of administration. So very, very similar to RRSPs, where you provide the employee with an enrollment information package and all the forms to get up and running on the program. Again, usually the provider provides all that to you and it's done in advance. You forward the completed enrollment form to the vendor in order to get them up and running. You set up your pension adjustment calculations for your payroll system. That's an important step that you don't have under the RRSP. Submit your contributions as well as the listing every pay period or whatever frequency you'd like for remitting those contributions. A lot of times, I'll be honest, on DPSPs, we see an annual contribution versus a monthly, unless there's some type of matching component. Advise and discuss any amendments or changes in plan design. So on an RRSP, really, if you make changes, the vendor doesn't really always need to be aware. You just impose that internally as a provision. With a DPSP, because it's registered, your plan text is registered, any changes and any amendments should always flow through your vendor to ensure that all the proper registration forms are done and everything. Terminating a member from the plan, very simple again. If you're going through a vendor, your trustee is going to handle it from that point forward. They'll ensure they get an option statement, they make a decision, or they'll cash them out and you're good to go. Okay? There are some restrictions on plan designs for employers when it comes to DPSPs. So I say there's minimal plan design rules and regulations. So the first one is on eligibility. So not everybody is eligible to receive benefits under a DPSP. The biggest one is significant shareholders and their family members are not eligible to have contributions put into a DPSP on their behalf. So if it's a partnership, same idea. So a person related to the member of the partnership is not allowed to have benefits in a DPSP. My general thoughts on that is the government saying, you know what, we don't want family-run operations to be able to soak away more money for their family than the average individual can. Okay, so that's really why that rule exists. The plan can be for all employees or a certain category or group of employees again. It can differ by category, it can differ by group, so you're not limited to making the plan for everybody the same. It can be voluntary and compulsory in nature. Again, any plan that's compulsory, I definitely strongly suggest make that a condition of employment and in your employment offer. Unfortunately, if you do it at the end of the day, if you don't put it in your offer and you don't let them know up front, they'll challenge you if the plan is compulsory in the future. Contributions. Same idea as an RRSP other than no employee contributions. So only employer contributions are permitted. Employer contributions, as I mentioned, are non-taxable, so it's totally deferring the income for the employee. The employee contribution formula must either be from profits or have reference to profits. So what we'll typically see is a percentage of profit. So in that case, you'll wait to the end of the year, figure out what your profits are, and then it's a percentage of profit that's actually distributed amongst the members of the DPSP. Or it must be paid out of profit. So one of the ideas or one of the formulas we see when it's paid out of profits is we will match employee contributions up to 3% out of profits. So the out of profits just has to be in that formula. Okay, so again, really important that that out of profits be within the contribution formula in order to get registered. Contributions can be dependent on employees contributing to another even tax type. So the formula can say, you know, we're going to match your contributions to the RRSP in the DPSP. Again, lots of flexibility on what percentage of max and how to actually match that. So again, lots of flexibility. The frequency of distribution and contributions in a DPSP is usually, depending on if there's a match or not, usually monthly, or I see a lot of them, to be honest, that are annual. They'll wait till the end of the year where profits are declared, then they'll actually do the distribution in the next calendar year for the previous year's profits. Okay, so the best thing about a DPSP, even if it's registered with a specific contribution formula, is there are no profits in a year, there's no requirement to put money in. So I know Dean's going to talk about true pension plans. In a pension plan, it doesn't matter. If that formula says you have to put in 1%, you can cheat, die, retire, that 1% has to go in, whether you're profitable or not. So a little bit of, I guess, more flexibility on a DPSP when you're unsure as to the stability of the profits within an organization. Vesting. This is new in DPSPs that don't exist in RSPs. So as I mentioned earlier, money that you put into an RSP on behalf of an employee belongs to them. You can restrict when they can take it out, but it belongs to them right from the beginning. In a DPSP, this is one of the things that's becoming more and more popular, or one of the features that makes them more popular, is that you can put a vesting provision in a DPSP. So what does vesting mean? Vesting simply means what is the waiting period for a participant in order to have access or own those actual contributions. So I can be putting money into a DPSP on behalf of my employees, but until they meet that vesting provision, they're not entitled to it should they leave. So right now in the legislation, the maximum vesting provision is a member must be entitled to the benefit once they reach 2 years of membership in the plan. Not service, but membership within the program. You as an employer have the option to do anything better than that. So the maximum is 2 years participation, but you can say, you know what, we're going to put money into a DPSP, but it belongs to you immediately. So that's immediate vesting. You can also put in a 2-year service, which is usually better than the participation. So again, you have a little bit of wiggle room between the 1 and 2 years participation to create your own vesting provision. That, in most cases, is really popular with employers because it helps create some loyalty. Yes, we're putting money in here, but should you leave before you have 2 years in the program, you're going to forfeit all that back to me and walk away with nothing. So it does create a little bit of loyalty. Okay, I've talked about that. Withdrawal restriction options once vested. So the legislation basically says that should an employee be vested, they have the right to move their money at any time or take it out in cash. There's no requirement to terminate employment. So as an employer, and I see 99% of these, you have the choice, again, to restrict the withdrawal of the money completely until they terminate, retire, or die, or B, impose some type of penalty yet again, should they decide to do it while they're employed. Again, lots of flexibility on your design around that. So TFSA, I'm not going to get into too much details about TFSAs, but I will tell you that it is a product that most vendors have available on a group basis. It's a loss leader, and I'm going to say that honestly. Most individuals use a TFSA more as a short-term savings vehicle. They're better served in the retail market. Unfortunately, as an employer, you're going to add a lot of administration for very little results. So again, we offer it. It's part of our package. I would love to sell one, but at the end of the day, they're not being used very often, and even the ones that are using them, they're using them more as bank accounts. So very much a loss leader in what I see. TFSAs, the biggest difference between a TFSA and an RRSP is your contribution is not tax deductible, but all of your accumulation is. Also, when you withdraw money from a tax-free savings account, none of it's taxable. Okay, so the tax convenience is more in your accumulation or your returns. Okay, so that brings me to evolutions and trends. So just to give you an idea of what we're seeing happening in the CAP environment. So I refer to CAP because capital accumulation plans is what we've been talking about. A CAP is an RRSP, a TFSA, a defined contribution pension plan, a DPSP. So what am I seeing? What we're seeing in our industry is a real shift from pension plans, defined benefit pension plans, which is our government type plans, to what we call defined contribution plans, which are very similar to RRSPs, and I know Dean's going to touch on that. So we're seeing a huge shift from DB to DC. Why are we seeing that? A couple of reasons. DB plans are very, very complex to administer. There's a lot of maintenance involved, and the biggest reason we're seeing it is in a pension plan, a defined benefit pension plan, the employer assumes all the investment risks. So with the latest since 2008 and a little bit along the lines, lots of unfunded liabilities when it comes to DBs. So they're really looking at going DC. Again, I know Dean's going to touch on that. So what I'm seeing most often in the marketplace today, and what we all are, is you're either seeing straight up group RRSPs or we're seeing an RRSP DPSP combo. Okay? We are seeing some TFSAs, but again, I believe they're loss leaders, and from an administrative point of view, as an employer, I think they're too much trouble for what the return the employees are going to get in. Why are we seeing that? Ease of administration and limited government rules and reporting. Honestly, that is what's killing most of our employers in offering a program. They just don't have the staff or the time to be managing a pension plan. So biggest evolution and trend is still member engagement. I can tell you, even employers that have a plan in place, the toughest job for them is engaging employees to take advantage of the program or engage them in even having an interest in the program. Most people spend more time planning their vacation than they do their retirement planning. So unfortunately, it is a big issue. So what we're seeing happening in the marketplace, mainly out of the US, we're going to see it hit Canada very quickly, is auto-enrollment and auto-escalation. So what that means is an employer saying, you know what, as a condition of employment, you're in the plan after so much time, 3 months. After 3 months you're in the plan, you have the option to opt out because it's not compulsory, but you're automatically enrolled after 3 months. The experience has shown us people aren't opting out, which is great. So we're seeing higher levels of participation. The second one is what we call auto-escalation. So they're enrolling them automatically, but then every year their contribution levels are changing automatically. So we'll auto-enroll them at 1%, and then every year that percentage is going to go up by 0.5 until they reach a certain maximum. Typically that would be 3%. Again, people aren't opting out. So in the US, we're seeing more and more money going away for retirement, more and more people covered because inertia sets in and they don't do anything. But this time inertia works in their favor. They're in it, they're not out of it. Okay, so that's some of the things we're seeing put in place. Employers and industry leaders are putting more focus on the de-accumulation stage. So, you know, we talk a lot about retirement savings, accumulating assets. The biggest push to me and the lack that we've had in the past is, what do they do once they hit retirement? What do they do with this bulk of assets? So we're going to see more and more, and I hope to see more and more emphasis on what are you going to do at retirement? Because I can tell you, it's really important to understand your options far before you're actually ready to make a decision on what your income option is going to be. So we're going to see more and more in that, and I really am a big believer that we need to see more and more of that. Okay. Last but not least, there was an introduction, and this is, you know, even though it dates back to 2004, I'm sure Dean will agree with me, it's amazing how many people don't even realize they exist, and it's been 10 years. So what happened in the DPSP, RRSP, and TFSA world is employers weren't doing their jobs. The employees weren't doing their jobs, and the vendors weren't doing their jobs. I'll be honest, all parties involved were not doing what they needed to do, mainly because there's no rules, so why are we going to impose some processes? So what happened in 2004 is CAPSA came out with CAP guidelines. These guidelines were created to help employers, vendors, and employees have a better understanding of the programs and ensure that you're provided with all the information to make informed investment decisions. So they did come out in 2004, and they are going to continue to be a big part of the defined contribution world. So I've gone through most of their responsibilities, but again, I put a chart together that kind of helps you understand what parties are involved in a defined contribution or a capital accumulation plan, and who has responsibilities. Even though you can delegate some of those responsibilities, you are still responsible. Okay, so the key one that we try to focus on is members. That helps with engagement. We have to remind them that this plan is great, but if you don't take advantage of it, it's not really that great. Okay, so making sure they understand their responsibilities has been a big part of our role. Savings trends. According to Stats Canada, they do this survey about every 10 years, so I went back and tried to find the most recent. Unfortunately, it's back to 2008, but I put it here because in reality, I haven't seen much of a change or much of a difference. So back in 2008, tax filers participating in a retirement program, again, not just pension plan, but group RRSPs and DPSPs, 32% were members of a private pension plan. So now we know why there's so much talk of reform. Not very many people have access to private plans through their employers. So there's a big push to try to help that. And 63% of those 32 were between the ages of 35 to 54. So there's a gap in the younger generation, and there's a gap in the ones nearing retirement. And as we all know, 65 isn't the norm anymore. People are retiring later and later. So that gap is huge, and those are the ones we really need to focus on to help. There's a large gap in coverage for small businesses. We've done lots of research on that. I can tell you, most vendors have created a small business product in order to help shorten that gap. Bottom line, Canadians are not saving enough for retirement. We all know that. And what can we do? So what can we do to help? Well, there's only a few options that we have. do nothing in hopes that individuals take their own responsibilities. Well, we've done that in the past, and unfortunately, what's happened? We're not seeing increases. Unfortunately, this is just my opinion. I won't admit to it to the authorities, but one of the biggest problems I see is we created CPP back in 1966. The YMPE is far from being the medium of our income earners. You know, our middle income earners are earning in the 80s. So YMPE is cutting us off CPP at about $50,000 a year. I believe that's the biggest problem. The gap is there. Increase that YMPE so that people making middle income can actually gain from CPP more than they are today. But again, that's just my opinion. The second option is we pass legislation. We know that government's coming into it. We know that they're really concerned. So there's two options. Pass legislation that provides access to group savings plans through the workplace. So all of the PRPP work or all the PRPP, communications or what you've heard on them, it really is the government saying, we just want to make sure employers have this available to them. They don't have to put money in, but we just need to make sure we impose that they have to offer a program. And then, of course, we have the new provincial pension plan, which is ORPP. Very different beast. So the ORPP is really out there saying, you know what? We need to really supplement CPP, and Ontario is going to take a stand and add some payroll tax. So ORPP is not just to offer a program, it's imposing a 1.9% contribution level to employees and employers. So again, why? The biggest problem is people aren't saving enough for retirement. So the more we can do to help ensure that employers have access to this, the less of this pension legislation we're going to see being talked about and being imposed on everybody.